Good morning, everyone, and welcome to Managers and Director Educators, also known as Made in Florida program. We're pleased to be able to bring you today's session, which is focused on budgets and reserves, but we're also excited to share with you some helpful tidbits to help keep you sharp and laser focused as you move forward on your budget season. The format for today's presentation, we'll be looking at the accounting side of the budget and the reserve process, and then we'll get into some legal considerations and closing out with a question and answers. As we go through the presentation, if you have any questions, please type them in the chat box and we will try to address them during the presentation, but they may roll into the end. Today's presentation is worth CEU credit hours. And in order to be able to give the credit hours, our software does monitor login status. If you're looking to receive credit, you will need to stay in for the entire presentation. We will be submitting the CEU hours later this week, and we will also email you a copy of your certificate of completion. So if you have questions on the programs, or if you would like to obtain a copy of the presentation, you can email them to our coordinator at managersanddirectorsedu@gmail.com. So to keep things fresh and to have you hear things from a different perspective, joining us today is Christopher Miller from Godey, DuBost and Cross. Chris, would you take a few minutes to introduce us and tell us a little bit about yourself?
Good morning, everyone. My name is Christopher Miller. I'm an attorney with Godey, DuBost and Cross, as Rain just pointed out. My area of focus is condominium, HOA, co-op association law, as we generally refer to it. I've been in this area of law for quite a few years now. I learn something new every day, so I'm hoping I can share some of that with you all in the context of budgets and reserves, which are incredibly important this time of year. And hopefully we'll get a good class out of this. Rain, back to you.
Wonderful. And so those of you who are not familiar with me, my name is Rain McGreevy. I'm one of the directors at Stromer and Company. Our firm really specializes in doing accounting for associations as well as some nonprofit and for-profit. We do some bookkeeping, tax, audit, as well as some consulting. So we offer a variety of different services for different communities as well as for some other businesses. So without further ado, I'm going to go ahead and get started with the presentation. Bear with me just a moment as I get everything set up on my screen so I can share this information with you. My apologies, always as you're trying to do something, it's always too many things at one time. So bear with me just a second. Let me get this one closed down and get this one opened up, and we will get this show on the road. Here we go. So budgets and reserves, that's our topic that we have for you all today. So some of the things that we're going to talk about is we're going to get into the budget process. We're also going to talk about reserves and the different methods associations can use for funding, which is primarily the straight line and the pooling method. We're going to go over some different reporting requirements as well as the legal considerations, and then of course time for your questions and answers. So let's go ahead and talk about this budget process, as I'm sure many of you are already in the midst of it. If not, I'm sure you'll be working on it soon. Now, every year, your association is going to be preparing an annual budget. It's going to reflect the needs and the policies, as well as the goals of your associations for a period of time. You're identifying the different sources of income, all the different expenses, as well as providing a basis for calculating your assessments. Now, one thing that many people kind of forget is that when you prepare your budget, it's actually going to be a tool that your membership is going to be using to understand the goals that the board has, as well as a tool to evaluate the board's performance. This is something that some of us forget about, and we just roll over budgets from year to year, but it's really important because now you're giving your unit owners the opportunity to understand what exactly the plans are, and as well as a basis for the board members to be evaluated. One thing that's important when you're putting together your budget is you need to have the beginning and the ending dates covered in your budget. Many associations prepare their budget, they roll over the schedule from the prior year. And unfortunately, when I come in, I take a look at it and I start asking questions because the dates at the top are the same as the prior year. So make sure that when you're going through that process and doing your budget, that you update your template, include the correct dates. Very important that you do this on all of the schedules. Typically, you have one page for your operating budget and a second page for your reserve budget. Make sure you update that reserve page as well. Your annual budget also must include the different assessments for each different unit type. If you have a community where you assess different rates for 2 bedrooms versus 3 bedrooms, that information needs to be identified in your budget. Common expenses of your association must be presented on an annual basis. If your association does quarterly and you choose to have a quarterly funding, you certainly can have that information in your budget, but you must present everything on an annual basis. Also, limited common elements. Limited common elements are those areas that not everybody has a direct usage of. Think about carports, garages. Only certain unit owners may have them, and they have to pay a different amount related to that. So it's important in your budget that you have a separate schedule or a separate area just for those limited common elements. And lastly, when your association puts together your budget and you think about your reserve items, make sure you're considering all of the different components that your association is reserving for. In addition to identifying the components, you have to identify their estimated useful life, their estimated remaining useful life, replacement costs or deferred maintenance, as well as the ending balance at the beginning of the year, as well as the annual funding. We'll get into some more of that as we get later on, but make sure you're including that information in your budget. Now, here are some different requirements of what must be included in the operating side of your budget. This comes right from the Florida statutes, as well as some information from the Florida Administrative Code. So when you look at your revenue sources, you have to include your assessments. Also, if your association has a large amount of funds that are coming in for interest, insurance proceeds, or some other type of income, maybe your community actually has antenna income. Those types of things need to be included in your budget under the revenues portion. When we start taking a look at expenses, here's a couple of items that's required by statute to be identified. So you have your annual condominium or co-op fees paid to the state, your insurance, your fidelity bonding, administrative expenses, management, maintenance, rent for recreation area, taxes on your property, as well as leased areas, security provisions, as well as other expenses from unit owner and the renting and leasing of equipment. Now, these items are specifically spelled out in the statute or the administrative code that need to be included, but your community can add items to this list as needed. I have some communities who actually like to have maintenance repairs as one line item, and it covers a broad range of different types of maintenance, including the clubhouse and irrigation. And I have other communities who actually like to spread that out and have those items segregated. This is really going to be at your association's preference of how detailed you want to get with this information. Also, what's important, if you're going to go through and you're going to budget separate line for these different items, it's also important that you have good communication and cooperation with your accountant, so these expenses can get recorded on the proper expense account, so that way you can compare budget versus actuals and actually see how you were doing based on what you were projecting how you were going to do. Some other things that you're going to need to consider when working on your budget, and this is really kind of some of the hard stuff that we all struggle with, is increases from vendors. Now, this is one thing that you can do with good planning. Start communicating with your vendors if you're still working on your budget process. Ask them what's going on. Now, one thing unique that's been happening in 2021 is, unfortunately, a lot of people aren't working and some places are actually short-staffed. On the accounting side of things, it was just recently that we heard of a local CPA firm that, unfortunately, due to some staffing issues, was actually having to terminate some different contracts. So this is something that you really need to start looking in advance and planning for these types of things. If you're still haven't hired a CPA to do your year-end work or your taxes, now is a good time to start communicating with them and get that established. The last thing you want to do is get to a crunch time and you don't have somebody lined up, or fees are much higher than you expected. Other things that really can affect your budget has to do with utility costs and insurance. Insurance is just one of those things that, unfortunately, because we live in Florida and we're impacted often by hurricanes, it fluctuates dramatically from year to year. The best thing that you can do is communicate with your insurance agent, ask them of what they think is going to be going on, of where they think the premiums are going to be for your association. So that way you can properly plan for it. Most communities, insurance is probably one of the biggest parts of their entire budget. Now, utility costs, those will go up and they'll fluctuate periodically from time to time, but they're a lot more stable. Unknown expenses. Now, unknown expenses, really, this is the best thing that I can say of where you're going to be needing the assistance of your property manager or some other resident board member that really knows your community. You need somebody to go out with you while you're doing your budget process and actually go and take a look at the community. Are there sidewalks that have been needing repair that we've been delaying for a period of time that we need to start addressing and getting that fixed? Are there other types of items that we've had? Maybe this last 2 years, we've had a lot of irrigation problems. You need to be considering of where you were the last year, as well as your property and different things like that. So that way you can consider some of those possible unknown or unexpected expenses. You also need to consider that you make sure you have adequate emergency funds. Nobody really wants to talk about hurricanes and making sure we have enough money because we know that that can get really expensive. But because we live in Florida, it's just one of the things that we have to deal with pretty much on an annual basis. So making sure your association either set some funds aside to do some type of cleanup after hurricane, possibly, budgeting aside part of your landscaping that you put away for cleanup work after hurricane. And if not used, maybe you can do some work in the fall in order to compensate for that. I see a question that came in. What is the best way to show unknown/unanticipated expenses on a financial statement? So when you have those unknown and unanticipated expenses, you don't really want to label it unknown or contingency. I mean, those types of things really kind of leave it open-ended. Most of the time, a lot of your unknown are probably for repairs and maintenance, and that's probably where you're going to want to put them. Some communities, they really do like to have a little buffer. If you really are persistent that you want to have a line item on there for a contingency, you certainly can, but you're going to want to keep that in the operating side of your budget. You do not want to put that into the reserve side of your budget. Okay, the comment here was truly unknown. I see a sidewalk that needs repairing, then I know about it. I'm asking about the stuff that just comes out of nowhere. Yeah, and I think like some of those items, if you truly do want to have a contingency item, you certainly can, but you're probably going to want to keep that item limited. You're not going to want to put a large amount of your budget in there. Most of the time when I see contingency accounts, it's a small percentage, maybe 1 or 3% of the total budget, just a few $1,000s. All right, let's see what we got next. All right, the other part of your budget that sometimes can be very difficult has to deal with delinquent unit owners. Now, some of your communities, I'm sure, have had some issues in the last year, while other of you have maybe just have been untouched by the whole implications from COVID. But here's what the information says in the statute so you're aware. So the Florida statutes for condominiums and homeowners associations, it allows for collecting the lesser of 12 months assessment or 1% of the original mortgage value. This has to deal with situations where the unit owner goes delinquent on their mortgage and the first mortgage company actually forecloses and then has to pay the association. I like to look at this and kind of just saying, probably one of the worst case scenarios, this is the amount of money that you're going to be collecting. Many times, units are able to be sold. You can work with the attorney and you can actually go through the foreclosure process. But this is actually what the statute says. And this is normally one of the worst case scenarios of how much money you're actually going to get. So what do you do when you start considering some of this? So when you're doing your budget process every year, you need to look at your delinquent unit owners. Look at how many unit owners are about a year delinquent or maybe getting close to a year delinquent. Think about what's going on with that unit. Talk with the property manager, talk with your attorney that's doing your collections. Find out and just to see if you actually think this unit owner is going to begin paying or if the association may be going through the process of actually foreclosing on that unit. If you determine that a unit is not going, that you don't believe it, you're going to be able to collect that. Include a portion in your budget for the bad debt for the upcoming year for that unit. You also want to consider about what other unit owners that you may be expecting to come up and become delinquent. Now, some of your communities, you're going to have 2 or 3 units every single year that gets delinquent that you have to go through this whole foreclosure process. Other communities, you're going to have more, and other communities, you're going to have less. And this is where I can't tell you what to do. I can just give you insight, but you have to look at your specific community and evaluate some of those different things. Okay, I see a question that came in. Unknown and emergency are both well beyond a reserve account, but it is difficult to put them in the operating budget, even though they might be substantial. Any suggestions as to how to convince an HOA board that such allocations are necessary as a reserve? So this does get to be a little bit difficult. When you have to work with reserves, most of the time reserves, and I know Chris will get into this later on, most of the time with your reserve accounts, there's for specific items. If you're a condominium, roof painting, paving. And if you have these additional expenses that come up that are greater than that, that's not something that you're reserving for, the board just can't decide to use reserve funds to pay for those items. They have to go out to the membership and seek their approval. So it's not going to be able to come out of your reserve portion, at least without the membership vote, but it would come out of your operating portion. Now, it is really hard because nobody wants to increase fees, especially for something when it's just, we want to budget and have some additional funds for unknown items and unexpected. The best thing that I could really just say is communicate and work together, the board, the membership, and the property manager. Most of the time, if everybody starts talking and working things out, maybe by some historical examples of, we had this happen last year and this happened the year before, it's probably in our best interest that we plan for it. We don't want to have a different type of special assessment. Those are probably great things that you can do in order to get everybody to work together with hopes that you'll actually be able to resolve the problem and resolve the concern. All right, moving on to one of my favorite topics is reserves. So reserves are any funds really other than operating funds, which are restricted for deferred maintenance or capital expenditure. The statutes actually do kind of go in and define what capital expenditure and deferred maintenance is. And capital expenditure is an expense for funds for the purchase of an asset, the replacement of an asset, or the addition of an asset. So these are kind of like the big tangible types of items that your community may have. Deferred maintenance is any type of maintenance or repair that will be performed less frequently than yearly and will result in extending or maintaining the useful life. When we start looking at the statutes of what the different requirements are, here's what the Florida statute says for condominiums. Condominium associations are required to have roof, painting, pavement, and any item that has a deferred maintenance or replacement cost in excess of $10,000. One of the common questions that many communities come up with when they're a condo association is they say, we have 2 pools and it's going to cost $6,000 to remarsite. The question comes up, do we have to reserve for that or do we not have to reserve for that? Now, the unique thing about it is when you start looking at different items, you can combine items together and reserve for them, or you can choose to keep them separate and not reserve for them. Most of the time, I look at it from a logical perspective. If it's going to cost $6,000 to remarsite your pool, most communities don't have that excess in their operating budget to remarsite it every few years that you need to do it. Most communities are actually going to go forth and combine the items together and actually reserve for it. Now let's talk about another item. What if we have a fence that goes around our community and it costs $5,000? By statute, you might not be required to actually have reserves for this, but your community association can certainly add additional items and add additional components that the association wishes to reserve for. The important thing about this is you must include that in your budget. That is what you're describing and you're explaining to your membership of what are the items that our community is reserving for. And if you don't have it listed in there, then you have not told the membership that that's what these funds are for, and you can't spend them for any of those other purposes. Homeowners associations, when we talk about reserves, and I'm going to touch this lightly because I know Chris will have a lot to add at the end about this. Before 2021 and July 1st, to be specific, the Florida statute, when we talked about reserves for homeowners associations, it didn't really have any requirements that reserves were required, but it did say a community association has established them if they were created by the developer or by the membership of the association elects to provide reserves. It also went forth to indicate that the board shall include, once they have been established, that the board has to include these items in their budget every year. Now, in 2021, there was an amendment, Senate Bill 630, which actually started changing this a little bit, and it actually went into effect July 1st. And now the way that the statute reads, it says that reserves are now established upon affirmative approval of the total voting interest. So it gets kind of into some unique and a little bit of a gray area of how do our homeowners associations, we had reserves existing in the past. Do we still have reserves? Do we have to get a membership vote? These are great questions and great questions that your association needs to consider and talk with your attorney about it. You might have to go back and dig into some old meeting minutes to see, was there a vote way back when we established this? Did the developer create this? So these are great questions. And it's one of those little tidbits that we wanted to kind of drop the seed with some of our homeowners associations that you need to really consider this, because if your association does have reserves, then you need to make sure that you're identifying and following things correctly. If your association does not have reserves that are defined by the statute, there's certain disclosures and questions and things that you need to be including either in your annual budget or your financial statements. All right, bear with me a second. I see a couple of questions coming in and I want to take a look at some of them. All right, question came in. Can you use a reserve fund for emergency expenses such as hurricane cleanup? Chris, I think this would be a little bit better of a question for you. I don't know if you'd be able to jump in and answer that with us.
Absolutely. So if you have a reserve line item that generally would cover hurricane cleanup in it, then yes, absolutely. You can use the funds that have been allocated towards that line item. If you haven't, which is more likely the case, then the answer is you still can, but there's a process that has to be done. In order to use any reserves for a purpose other than which they were originally intended, you have to go get the membership's approval. It requires a majority vote, and there has to be a disclosure on the proxy that's required by statute. It's got to be in all bold that essentially alerts the homeowner that if you're going to either waive reserves, which is something we'll cover later, or if you're going to use them for an alternative purpose, this exposes the homeowners to potential liabilities for special assessments. Now, in this particular case, we're using the reserves to prevent arguably a special assessment, but that disclosure is still required. Assuming that we have a majority of the members at that meeting approve the use of those funds for the hurricane cleanup, yes, we absolutely can. If, however, the homeowners say no and we fail to get that majority vote, then we can't use the funds for that purpose. And the association is going to have to look at other avenues, whether that be procuring a loan or levying a special assessment to get the funds necessary for that cleanup.
Perfect. Thank you so much. All right, a couple other questions that came in. Is it true that insurance agents and companies cannot or will not release the cost of premiums for the next year's renewal more than 1 month ahead of the renewal date? If so, how can an association budget for insurance when the renewal date of its policy is December 19th of each year? In other words, is there a minimum amount of time by which the insurance companies must release the new year's insurance premiums, costs, or increases? So that is not something that I can answer. I don't know if Chris is very familiar with the insurance side of things. But most of the time, from at least what I understand when it comes to the insurance thing, insurance companies, the actual companies, will only quote things out for a limited period of time, meaning maybe, forecasting it out of the next month, maybe 6 weeks. I don't think things can be forecasted out for 6 months or 9 months out. However, most of the time, a good insurance agent is going to be able to give you an idea of the trends of what they're seeing with many community associations when it comes to their premiums, whether they're increasing, decreasing, remaining the same. Maybe certain carriers are actually starting to drop off certain lines of business or certain community associations. So it is difficult in the aspect of you're not going to be able to go out to your insurance agent and ask them for a quote for next year's policy and be able to run with it. But you should have a good working relationship with your insurance agent where they can give you some expectations of where they think the premiums are going to be for the next year. And that should assist you with your budget process. Chris, did you have anything to add to that?
So I'm not aware of any statutory requirements that would govern an earlier notice than a month. There may be some contractual ones that you want to consider. So work with your association's legal counsel to see if inside the policy itself it dictates a earlier notification. But I would say that Brain is spot on. Work with your agent. Your agent's going to have a really good sense. It's more of a complicated issue. Insurance carriers don't have the right in the state of Florida to just unilaterally increase prices. The state of Florida has some pretty broad oversight on that with the Office of Insurance Regulation. So it's a very complex issue, which is why we just now recently saw a lot of the rates increase as a result of Irma and Michael. We didn't see those immediately after. And again, that's because of the technical nature that comes in with those rate hikes. So work with your agent. They should give you some forecasting. The other thing too is if all of a sudden you see a very dramatic change, you always have the option to shop around and potentially amend your budget. If we got this horribly wrong because insurance is going to come in and they're going to quadruple costs and we can't get a cheaper rate, look to amend your budget. That's always an option. Your bylaws will probably have a provision regarding how that process is carried out, but sometimes just amending the budget is the best option because at the end of the day, we have to carry that coverage and there's nothing we can do.
Wonderful. All right. I know there's several more questions, and what I'm going to do just for now is I'm going to hold them off to the end because I feel like a lot of specific questions, and we'll address all of those and we'll go through them as we get through on the end. We should have enough time to get through most of everybody's questions. All right. So the difficult part when it comes in with doing your budget when looking at your reserves has to deal with your estimates. Now, we talked that in your budget, you need to be identifying your different components that you're going to be reserving for. But very importantly, related to that is you have to have good estimates put into your budget so that way you have a good output of how much you need to have for your funding. Now, you need to include estimates of the estimated replacement cost of your different components, the estimated total useful life, as well as the remaining useful life. Most community associations can find it very, very useful to actually obtain a formal reserve study. There's many different reserve studies out there that will come out that will evaluate your community association and will generate a report that you can use to identify how much the different items are going to cost and how long they're going to live. Now, what's really important that when you're actually having that process of having your reserve study done, have that property manager who knows the property, have that unit owner, have that board member, whoever knows a lot about your property and some of the repairs and different things that have gone on over time, have that person talk with the reserve study company, have them explain to them. On building 3, we had an issue with the roof 3 years ago, and we had to have some patchwork done and we had to have some repairs done here, because all of that is going to give more useful information that the reserve study company will be able to use so that way they can give you accurate and factual information. Now, one question that always comes up is how often should we have a reserve study? Do we need to have it done annually, every 3 years? Now, make sure that you understand a distinction between the insurance study, because insurance, I believe it's every 3 years you have to get an updated, I don't want to call it an appraisal, but an evaluation done. That's different by an actual reserve study. So with the reserve study, most of the time we see a lot of associations have a reserve study done annually. They're going to have a big one done about once every 3 to 5 years, but then annually the reserve study company will come in. They'll take a couple of different updates. Maybe you had some repair work done during by the year. They'll also input it and give you some updated information based on recent trends of how have the costs related to different repairs and other work done. I think everybody knows the cost of anything today was significantly different than it was a year ago due to increase in gas prices and labor shortages and all sorts of different things. So it's very important that you have this information updated annually and you consider it. whether you're doing a formal reserve study or not, you need to do your diligence. Don't just roll over the information from the prior year, blame it on the prior board and saying, well, we have bad reserve information. We thought we had enough money for the roofs and we really don't. If you're a board member, if you're a property manager, make sure you're doing your due diligence and update your information. I know it's not a popular thing to have to increase assessments. Nobody wants to do that. But if you're not going in and updating the information and making sure your association has enough money set aside, then you're also going to look like the bad guy when it comes out time to special assess. And people are wondering, why didn't we establish enough? Why don't we have enough money to replace the roofs? I can't afford this. And it's a whole different type of ballgame. All right, so let's talk about the different methods that communities associations use for reserves. First one we're going to talk about is the straight line method. The straight line method is a little bit more classic. A lot of people can understand this quite well. When you're under the straight line method of reserves, you identify your different reserve components, estimated useful life, replacement cost, and then you have to do this calculation, which is shown on the screen. The way you do your calculation is you take your estimated replacement cost, you subtract out how much your reserve fund balance is. That's really how much your association is set aside for that component. And then you divide that by the remaining useful life. That number is going to give you how much you need to be funding every year in order to make sure that you have the funds that are needed at the time that it's needed. One thing to consider, if for some reason you have a negative balance in an item, let's just say you overspent on the roof, it costs an extra $5,000. The statute does indicate that you must also bring that negative number back to zero. So if you were short $5,000, you have to first fund that $5,000 and then do this regular calculation. Here's a little bit of a visual aid so that way you can see what's going on with it. So let's just go ahead and pick the item, the building paint. If you go ahead and take a look at the building painting component, note that it has an estimated useful life of 5 years with 2 years left, and it has an estimated replacement cost of $80,000. Based on our formula of what we have to do, we have to take $80,000, our replacement cost, subtracting out what is our beginning balance. And on this one, we're saying we started with 0 and dividing it by the number of years that are remaining, 2 years. So 80,000 minus 0 equals 80,000 divided by 2 equals $40,000. That is the amount of funds that are needed every year in order to have $80,000 at the end of the 2-year life. So this is the calculation when you're doing the straight line funding. Now I'm going to be keeping all of this information the same when I do the pooling, but I want you to remember this. $77,000 is how much the annual funding is needed when you're under the straight line method. All right, little cursor. I wanted to get all fancy with everybody and move this thing along, but now it doesn't want to seem to let me to stop to move on. Come on, there we go. Now I got to clear my annotations. Sorry about that, everybody. Let me go ahead and get this clear. All drawings, perfect. There we go. All right, so onward to the pooling method. So the pooling method is another method that many community associations use for reserves. And when you're under this method in your annual budget, you're going to include many of the same similar items that you did as a straight line method. You identify the components, the useful life, remaining useful life, as well as the cost. And then here's where things getting a little bit different. You have to indicate the estimated total balance for the pooled reserves as of the beginning of the proposed year and the end of the year, and your required funding for the proposed budget for the pooled method. This doesn't make a lot of sense until I start showing you some stuff, so let me get that there. It also is important that under the pooling method, the ending reserve balance must never go below 0. You can't have any type of balloon payments, and the calculations must go out to the longest useful life. So let me show you what this actually looks like. So here we have our different reserve components: roof, painting, paving, and this one also has the pool remar site, the same cost, useful life, and replacement costs. So now, because we're under the pooling method, noticing our calculation and our schedule looks a lot different. The first thing we have to do is we have to look at the longest remaining useful life. And in this case, it's 8 years. So we have to go out 8 years in our schedule. Then we have to drop in where we expect those expenses to be. So let's take a look at roof replacement. We expect in year 8 for it to cost $120,000. So in year 8, there's $120,000. Building paint is in year 5 and we drop that in. And then you can understand how this works. What's important is if you are actually going in this process and putting together this schedule, you have to look at your different components because some items may actually have to be replaced more than one time on your schedule. So in this case, the building paint has a life of 5 years and it's 5 years out. If this only had a remaining useful life of 2 years, we would have it in year 2, and then we would likely also have it in year 8 because that would be coming up for its second time that project would need to be due. Here's our projected outflows for the year. And then down here at the bottom, here are those other items, which is hard to describe until you see it. Here's our estimated beginning cash. Here's our annual reserve contribution. And then here's our ending cash. Remember one of the items it said, we cannot have an ending balance that goes below 0. So when we look at this schedule and we break everything out, the lowest balance that we actually have is in year 1 and it's at $47,000. So that's the lowest balance. So we can check off on that box. We also have to make sure we don't have any balloon payments. What the intention is with that, the way that we understand it of the statute is that every year this funding is expected to be consistent. Now you're going to have deviations that may come up. We budgeted $47,000 this year. When we did next year's budget, we said that we need to start doing 50, and that's okay if you're going to make adjustments, but the expectation is for this to remain flat. Now remember earlier I told you to remember that $77,000. Under the pooling method in this example, it's $47,000. You can actually probably even be less than this, but this was the amount that was indicated on here to be annual reserve contribution in order to fully fund under the pooling method. Many people get really excited about this and they think that there's found money, that now your association is going to be able to save thousands and thousands of dollars. And the truth really is that under the pooling method, you have a better utilization of cash. There's funds that you've set aside and you can use them as needed to pay for these different items. And you don't really get into kind of a bind in a tight spot. It's also beneficial under the pooling method for when you have a little bit of fluctuations in your estimate. So let's just pretend, let's go back to that painting item for $80,000. If you budget and you have $80,000 and you're under the straight line method for your building paint, and the cost is $90,000, you only have 80, you're going to be short $10,000. And you're going to have to figure out where you're going to get those funds from. So you may have to go out to the membership and ask their vote to use other reserve funds for other than its intended purpose. You might have to use operating funds. You might have to special assess. Under the pooling method, you really just have to look. Do we have $90,000 available? Yes. Okay. Let's go ahead and use these reserve funds for it. It's part of the pool. You can account for some of those differences in the estimated cost. Here's a visual that I like to kind of give to everybody to understand the difference between straight line and pooling. Under the straight line method, which is on the left side, you have separate envelopes for roof, painting, and paving. You can only use the funds that are inside each envelope for the item that they're identified for. Under the pooling method, you have one larger envelope that's identified for roof, painting, paving. There's no little separate envelopes or folders inside that big one. It's just one big pot of money that you can use for the items that are identified. Roof, painting, paving. If your estimates are a little bit more, if there's enough money in there, then you're going to be free to use those funds for that purpose. Now, switching from the straight line to the pooling method, this is something that many community associations have done. There's two things that you need to consider. One has to do with the funding. How are you putting money inside those envelopes? Are you putting them into the separate ones or are you putting them into the larger ones? And the other thing that you need to consider is how about the funds, the money that was previously accumulated? What about the money that was already inside the envelopes? It's important to remember what the statute says And it really is, reserves can only be utilized for their intended purpose unless the membership is voting to use them for some other purpose. So if you're going to be taking money out of those different separate envelopes, the roof envelope, the painting envelope, the paving envelope, and putting it into the big one, you need to go out to the membership because you're now utilizing those reserve funds for other than its intended purpose. Reporting requirements, and I'm just going to lightly kind of touch on this because it is important for you to consider when doing your budget. So for condominiums as well as homeowners associations, here's the different accounting reporting requirements so that way you're in compliance with what the statute says. So if your association has less than 150,000 of annual revenues, the statute requires the cash receipts and disbursements. Between 150 and 300,000 of annual revenues, your association's required a compilation. Between 300 and 500,000, you're required a review, and greater than $500,000, your association's required to do an audit. Now, if you want to understand the difference between a compilation and review and audit, I can go over the information on the slide, and that's going to be useful to you. But I also like to give a little bit more kind of common sense type of explanation for what's the difference between a compilation and a review and an audit. And I like to always use when I'm in person, and I don't know, hopefully my computer does it. This is just a plain old bottle of water. And this is my visual prop that I've used for years and years. So if you ask me, you said, Rain, can you perform a compilation report on that bottle of water and give me a report? So, okay, I'm going to go in, I'm going to look at the bottle of water. Yep. All right. It looks like a bottle of water. Great. I'm going to prepare a report for you. I'm going to put it in the right format, checking all the boxes of the disclosures that need to be made. And I'm going to deliver you a report. I'm not going to test it. I'm not going to analyze it because in a compilation, that's all that the CPA is required to do. Put the information in the proper format, ask whatever questions are necessary to make sure you have all the disclosures that are necessary. No assurance is provided by the CPA. They're not telling you that the number is good, reasonable, anything really. They're just presenting it in the right format. If you ask me, Rain, can you do a review on this bottle of water? I'm going to say, absolutely. I'm going to ask questions. Where did it come from? I'm going to compare it to other known samples of bottled water. Okay, yes, it's expected to be clear. Is this the expected colors that it's supposed to be? And I'm going to provide a report that provides limited assurance. And I'm going to say, for the most part, I do believe that this, in fact, is a bottle of water. I inquired about it. I did some analysis on it, and it does appear to be a bottle of water. Now, in an audit, I'm going to go even a step further. I'm going to inquire about it. Where did it come from? Maybe I actually want to see the receipt where you got it from, so that way I can test it and prove it out. Maybe I'm actually going to take a sampling of the water, not all of it. I'm going to take a sampling and send it off to a lab and ask them to confirm that, yes, it's a bottle of water, not some other type of clear liquid. And then I'm going to provide a report. It's going to have all the disclosures, just like we would have in the compilation or the review report. But now my opinion changes. Now I'm actually going to form an opinion. I'm going to say, I believe that this, in fact, is a bottle of water. I'm going to provide to you assurance, and it's a reasonable type of insurance that this information is, in fact, a bottle of water. The key thing to note is we're taking a sampling. Not all of the molecules of water are going to be tested. It's important to note when you're looking at the financial statements and we're going in and doing an audit, we are not testing every single transaction. So the perception that the auditor is going to catch absolutely everything is not true. An audit is going to cost a lot of money if you expected them to test all of the transactions. And it's not really going to be something that's in the financial interest of any community to have all those transactions tested. A couple more things that we just wanted to lightly talk about on the waiver of your annual reporting requirements. So when you look at an audit or review or compilation, we went over the slide that talks about what type of level of financial statements you have to have prepared. But many communities choose to waive them. That's okay. But you must also note that when you're waiving it, you must waive it in the year that you're doing it. So if you waive it in 2019 or 2021, it's going to be for the year 2021. You can waive for the next year for 2022, but you cannot waive backwards. So if your association has your annual meeting in March and you're expecting to ask the membership to vote to waive the prior year reporting requirements, you're not meeting the requirements of the statutes. It's also important that when you waive to do whatever level is, you still have to do something else. And in no way are you completely off the hook and don't have to do anything. If you're required to do an audit, you waive that. You can go ahead and have a review done or a compilation or at a minimum cash and disbursements, but you can no way waive the audit and expect to do nothing. So it's a good idea when you're waiving it that you make the mention in the meeting minutes that you're indicating of what type of level of reporting you actually do wish to go ahead and do. Now let's take a minute just to talk about this cash receipts and disbursements, because this is an unfortunate thing that I see many associations choose. We have over $500,000 of revenue. We asked a membership vote. We're going to waive to go ahead and have the audit done. And instead they just produce their internal financial statements and they says, yep, we're meeting the requirements. Well, let me just inform you about the cash receipts and disbursements. Cash receipts and disbursements is a different type of report than most everybody is used to seeing. Most of your financial statements that you're going to be seeing is what is on the accrual basis of accounting. And I want to make things as simply as I can because I know a lot of you are not accountants. So under the accrual basis of accounting, you report revenue when it's earned, not necessarily when it's received. So let me put it into perspective like this when it comes to your assessments. It's an easy way for any of you to look at your financials and to determine what basis you're on. So we all know that we have our assessments, whether it's monthly, quarterly, annually. There are some people who pay in advance. There's some people who pay late or maybe not at all. If you were to look at your income statement and you look under your revenues and you look at your assessments, most financial statements, they're going to have assessments and you're also going to have a budget number. If your assessments equal your budget number, and they do pretty much every single month, then likely you are on the accrual basis of accounting because you're recognizing it as you're earning it, as the membership, is supposed to be paying their assessments. Under the cash basis of accounting, you recognize the revenue as you collect it from the membership. So if people prepay their assessments, then you're going to have more revenue. People don't pay, you have less. So your cash receipts and disbursements is on a different method of accounting than most of the internal financial statements. In addition, the statute and the administrative code actually has specific disclosure requirements that need to be made in these financial reports. So most of the time, your internal report that gets distributed, it just has a balance sheet, revenue and expenses, maybe some reserve information, but it doesn't have all of the disclosures that's required. And some communities could also be facing where unit owners get hold of this information, they make reports to the Department of Business and Professional Regulations, and then you get turned into this ugly little rigmarole that you have to go out and making sure that you get this new report prepared and the added expenses that are associated with it. So I tell you this because I don't want you to fall into that pitfall. Don't just distribute your annual financial statements and believe that that's in compliance with what the statute says. So if you're in doubt, if you're not certain, hire a professional, consult with a professional, read the statutes to understand what you need to do if you're going to be choosing to do this internally. And now I'm going to turn this over to Chris, who's going to give us some legal considerations of things that we need to talk about when looking at our budgets and reserves.
All right. So essentially, there are a couple big points that I wanted to hit on, make sure everybody's aware, whether you're a manager or whether you're a board member. Chances are I've got some information that you need to be aware of. The first thing I like to discuss is statutory versus non-statutory reserves in an HOA, because this is probably one of the most confusing topics there is. If you're a condo or a co-op, sit back, this does not apply to you. But if you're an HOA, you need to take a look, like we talked earlier, about were reserves established previously in your community. We had the change in the statute this past year, but for the vast majority of associations right now, that change probably won't matter. What happened was either the developer, before they ever conveyed a single lot, decided to establish reserves when they were the sole member of the corporate entity of the association. Or at some point after that time, generally after turnover, the membership collectively got together and said, we want to go ahead and we want to establish reserves, and we got that majority vote. That's generally the two ways you'll see it. We now have some interesting ways where it might happen outside of those two circumstances, but in general, for most existing associations, that's going to be your consideration. If that happened, then we're going to follow all the requirements of 720, all of the how we come up with the numbers that we're going to fund, how we waive the funding. Essentially, at that point in time, your association, for all intents and purpose, is going to run like a condo when it comes to its reserves. You're going to follow all those same requirements. They're essentially the same in 720. It gets really tricky, though, when you don't have reserves that were established that way. Now, what do I mean? Non-statutory reserves are allowed for under 720, and essentially what it is when we don't have reserves under that membership vote, whether that be through the developer or through the membership post turnover, but we as a board generally are going to say we need reserves either due to the language in our documents or based on our belief to fulfill our fiduciary duty. And as such, we're going to create non-statutory reserves. These reserves are completely outside the scope of 720. 720 even states that if you create these reserves, all the requirements that we put forward in this statute don't apply. So that means your waiver requirements don't apply. All the rules go out the window. What matters at that point is what your documents say. So it's very important that if you're going to do non-statutory reserves, that we have some guiding principles in the governing document. Specifically, you want to take a look at your bylaws, the budgeting section, the reserve section, language that's in there. And if you have questions, you want to go to your legal counsel. We kind of hit on this a little bit earlier, but properly waiving reserve funding is going to require a vote of the membership. Generally, you're going to do this at your annual meeting. You're going to need a majority vote to pass it, and there's a disclosure that's required for all types of associations if you want to try and waive, unless you're a non-statutory HOA, that essentially alerts owners to, if we're waiving reserves, that again, we might have that special assessment happen as a result. The main thing there is the legislature really wants homeowners to understand what they're signing up for if they're waiving or choosing to partially fund. It can result in a special assessment. Special assessments, as we all know, are important because that can result in a lien or foreclosure of someone's property. So if all of a sudden your HOA or your condo comes knocking saying, hey, I need $5,000 from you in 30 days, and if you don't pay it, well, you signed up for this. So again, it's that you're making informed decisions, informed consent. That same disclosure is going to be required if we're going to partially fund reserves, which is allowed for under the statute. You don't have to fund the reserves at the exact amount necessarily set by the required calculations. Instead, we might say we're going to fund at 50% this year, or we're going to fund it 75% this year. It's the same process. You're going to put it on your proxy. You need a majority vote, same disclosure. The important thing, and I see associations get this wrong from time to time, if you're going to partially fund, you need to indicate the percentage of which we're going to fund. If you leave that blank, you're not allowing for informed consent, because you could be funding anywhere from 1% to 99% of the total reserves that are required if we don't waive it all. So I've seen associations getting issues with that with the courts and with the division. So make sure you indicate the percentage. It's otherwise likely an invalid waiving. Vote to use reserves. Again, we hit on this too. If you want to use reserves, for a purpose other than what they were intended, we need the membership's approval. We have those same disclosure requirements. We need the informed consent. I did see a question pop up. If we're on the questions here, if we're under the pool method, where we kind of have this greater flexibility with what we're going to do with our reserves and how we're going to use those monies, what happens when we have something that comes up that wasn't listed in that pooled list? So if you go back to the three categories we had, roof, painting, paving, if you've only listed those as your pooled items, and let's say now we have an issue with the seawall, which is something that very commonly happened as a result of Irma, a lot of associations figured out that wasn't covered by insurance and that they had to reserve for it. And so we were left with, what do we do? Even under that pool method, if it's not listed as an item that you reserve for, you need a vote of the membership. You can't just allocate those funds. It's got to be listed in that collective of the pooled items. Otherwise, we treat it like it's lined, and we treat it like it's for an alternative purpose. So hopefully that answers that question. Required disclaimers on financial statements. We also had a question about this. In 720, there are two disclosures that have to be made on the financial reports of the association. The first one is if we don't have reserves as the association, there's a disclaimer that has to go in there saying we don't have reserves, and essentially alerts the homeowners to the possibility of funding those reserves through a majority vote to establish them in the first place. So essentially, it's alerting the homeowners to, hey, there's this big thing over here that we don't have, but if you want to have it, here's how you can do it. So again, informed consent. That's really what the legislature is trying to get here. Number two is if we have the non-statutory reserves, and we're going to go ahead and create those, there's a disclaimer that tells the members, hey, this is not a statutory reserve. I don't have to follow, as the board, we don't have to follow the rules of the game when it comes to these. Again, informed consent. We want everyone to know what's going on. So those are the two big disclosures. If you're not sure which one's applicable or if they're applicable at all, talk with your association manager, talk with your legal counsel, talk with your accountant. They will guide you in the right way. Another point that I always think is important to bring up is the 115% rule in condos and co-ops. Essentially, if you're going to increase the budget from the number that it was in the previous year by more than 115%, there's this weird door that opens for the membership to essentially question that budget. And within a time frame, generally 21 days, if you get a written petition from the membership by 10% at least that says, hey, we're questioning the budget that you guys as the board just passed, and we want an opportunity to propose a secondary budget that would be adopted for this upcoming fiscal year instead, we have to essentially now call a meeting of the members within 60 days. It has all the notice requirements that you would normally think of, 14-day notice, affidavits, everything. And now we got to get all the members in a room, or at least attempt to, and see if they want to put forward a secondary budget instead of the one that was originally prepared and adopted by the board. It's incredibly rare that this happens, but you need to be aware of it. And the reason why it's rare that it happens is, while it might be easy to get 10% of your association to get together, sign a petition that says, hey, we don't like the budget, we want to discuss this, to actually get a second budget in place instead of the first, you're going to need a quorum to attend that membership meeting, and then you need a majority of your members to approve that secondary budget. As we all know, it's like pulling teeth to get people to appear at these meetings. So it's just not something we generally see happen. But I have seen when that 10% petition comes in, a lot of boards go, what is this? They have no idea what their requirements are. And so it's just something they need to be aware of and going forward. If this happens, immediately contact your associate's legal counsel. They're going to walk you through the process. The final thing that I wanted to bring up today, and I've had a lot of questions over the last several months about Surfside. And what is that going to mean for associations going forward when it comes to budgets and reserves and the safety of our members? Unfortunately, I don't have the answers for you. We're going to find a lot out this upcoming legislative session. A lot of different interested parties have been looking at the issues, what allowed for Surfside to happen, not only from a technical standpoint, but from a legislative standpoint, what safeguards might be implemented in the future going forward to prevent another tragedy like that from happening. And the suggestions that I've heard are all over the board, from the most extreme of circumstances to not so much. I've heard as extreme options as, we're going to restrict an association's ability to waive reserves. We're just going to take that ability off the table, and we're going to make it mandatory. From this point on, reserves are funded. Because part of the issue in Surfside was the members kept kicking the can down the road. I've heard that the legislature might take a more direct approach in regards to condominium co-op inspections. What I mean by inspections, I mean reviews of the building itself to make sure that it is still in good working order and address issues that might come up. Up until now, actually, for the most part, this has been handled by local government. The state of Florida itself has not taken much of a direct role on it. So I would not be surprised to see the state of Florida, through more than likely its existing division and the division of condominiums, co-ops, or mobile homes, the division, I'm just going to say, I can't talk today, essentially expand their role to have some additional oversight for safety purposes in a way that just they previously did. So again, I don't know how these changes are going to come in. The only thing I can really tell you with any certainty, if you're taking this class this time next year, I'm going to have a lot to talk about in that particular round. So I encourage you to attend. With that, I'm going to turn it back over to Rain, and we'll answer some questions you guys have.
All right, so I just wanted to put up on the screen, and I'll try to leave this on here for a few minutes. If you want copies of the presentation, there's the email address that you can send it to, managersandirectorsedu@gmail.com. And I'm going to go ahead and start taking a look at the chat of some of the questions that some people have. All right, so let me start up at the top of this. I saw a question here about have you seen a reserve item related to governing documents updates? We have been advised by our attorney that governing documents should be updated every 10 years, roughly. Estimated cost is in excess of $10,000. This is not something that I in particular have seen, but I don't think it's outside of the realm of something that an association could decide to establish reserves for. Chris, do you have any input on this? Have you seen anything similar, or do you have any suggestions?
Yeah, so it's an interesting question. I don't necessarily agree that you have to update your documents every 10 years. To some extent, it's going to depend on the legislative changes that took place in that 10 years leading up to the consideration to rewrite your documents. That being said, more than likely 10 years is a pretty good benchmark, and rewrites can be expensive. $10,000 is a little high end depending on the size of your association and its existing restrictions, but reserving for it is not a bad idea. You can go ahead and start putting that money away now, and so that your members feel very limited impacts of it, as opposed to putting your operating budget the year up. Generally, you can see the document rewrite cost anywhere from about $3,000 to about $10,000. So again, it's not a bad idea. I'm in favor of it, especially if your attorney's quoting you that high amount. I'm going to assume that there's a reason for it.
All right. Next question I have here. If a reserve study shows a significant shortfall, can the assessment be increased over several years instead of all of it in 1 year? And can the increase be subsidized by a special assessment? So in a case where you're having let's just say a formal reserve study, because I think that's where you're going with it. If the reserve study says it's, a higher amount than your association maybe can handle as some type of an increase. If you're accepting the reserve study and the estimates, but you're not willing to, or you don't want to assess the membership the full amount, then likely you're going to need to go to the membership so that way they can consciously acknowledge that they're partially funding the reserves. Even though you might not be able to have, such a large increase, that is really based on the estimates and the information given. That's really what your association needs to be funding in order to be fully funding. And anything less than that, then your association really should be letting the membership know, as well as obtaining a vote to partially fund the reserve funds. Chris, did you have anything that you wanted to bring into that?
No, other than my understanding is that if we have a reserve study that all of a sudden takes, let's say, our roofs that we previously thought we had another good 5 years on, and instead it's going to tell us 2, well, then our math changes because we thought we had 5 years to come up with that money. We now have 2. The math changes, and you're either going to do it through a budgeting standpoint during those 2 years, or you're going to do it through a special assessment consideration. That's generally your 2 options available. Outside of that, some way you got to come up with the money, and the only thing you can hope is that maybe you get a little bit extra time out of it to try and figure out your options.
Right. All right. I have another question. Can insurance increases be subsidized by special assessments? This is actually something, oddly enough, I have an association who doesn't include much in their annual budget for insurance, and they actually choose to special assess it every single year. It's kind of an oddball and a freak that kind of does it. But for this community, it actually works out better for them because their insurance company, I want to say their insurance policy is like a September year end. And it's just the way that everything falls at it. It's just too difficult for them. So they actually found it was better for them to actually go through and special assess. They're one of the few communities I have that do such a thing, but it actually is something that, some communities actually have to do. Because if you're budgeting for your insurance and then all of a sudden when it actually comes in, it's a sharp enough spike and you don't have enough cash to keep your association afloat, it's definitely something that you may have to actually subsidize and actually do a special assessment with. Another question that came in, it says statute says less than 50 units of cash receipts and expenditures. Does that mean we don't need a compilation? So this was something that was in the statute years ago. I want to say it was somewhere between 3 and 5 years ago. that the portion of the statute that talked about the reporting requirements and related to the number of units, it was eliminated. Previously, it had to do with the number of units, and now, and the way it has been, I want to say at least the last 3 years, maybe as long as 5 years, it is no longer based on the number of units. There's no relevance to it. It is strictly based on how much your annual revenues are of what type of reporting requirements your association is actually going to have to follow. Okay, so here's a question that came in. I have a feeling this one may be for you, Chris. It says, for an HOA, Florida statutes seems to say that, one, if the association does not provide for reserve accounts, you need big, bold disclaimers. And two, if the association does provide reserves, it needs another big, bold disclaimer. So either way, a big, bold notice is required.
Generally, yes. I will say that the secondary one that you're talking about in regards to having reserves, that one is applicable to the non-statutory reserves I talked about. And again, its main purpose is letting the homeowners know that it is outside the scope and limitations of 720. If you have statutory reserves, we generally don't need that sort of disclaimer, although kick that question to your accountant. They're going to tell you about every single disclosure that you're going to need on your financials, and it may be numerous, just depending on your particular situation.
All right, I have another question for you. If you're a condo associations, can you have non-statutory reserves?
No, because by law, you are required to have reserves. There is no option in a condominium and a co-op, essentially really any other type of association that's not an HOA, you're forced to have them. The statute requires it because of that unique nature of having one unified building that multiple people live in. We're always going to have those situations where there's generally a shared roof component, where there's a painting component and a paving component, and then our catch-all of $10,000 and more. You have them from day one. So there's no reason to have anything that's outside the scope of the statute. If you need to add reserve items, that's absolutely something that you can do.
All right, I have another question for you. Does the membership have to approve a special assessment?
So that's a great question. It depends on your governing documents. I have seen certain documents where the membership does have the right to approve a special assessment, and outside of a membership vote of some sort, the board cannot levy one. It's rare to see that nowadays, but it does potentially still exist, especially in associations that haven't updated their documents since the 80s, some even before that. I've got some associations that haven't been updated since the 60s. And that's because of more technical issues that they have, but check your documents. Additionally, and I wanted to raise this earlier, you might see an issue with the budget regarding membership approval of your budget. It is not a given that your board is the entity that approves the budget. You need to take a look at your documents, and you need to take a look at the statute as either the manager or as the board, and make sure that you're following the right path. If you're not certain of how you move forward, you need to go to your attorney, get a legal opinion written up, get told exactly what you need to do, because if you run into these issues, it's a lot easier to deal with it on the front end than to try and fix it after the mistake's been made.
All right. I know that there's probably some CAMs and other people here who have to go. We're going to continue to answer a couple more questions here for about another about 10 minutes or so. But if people do have to leave and they were wanting to make sure that they stayed long enough for the CAM credit, you're free to leave now, and we'll still be able to offer you the CAM credit. And I'll continue to go through some more questions that we have here. I have a question that came up. What do the statutes require for establishing amounts needed and useful lives for things like roads, pools, etc.? So to my knowledge, there's nothing in the statute that actually says how long the roads or the pool or the different items are going to exist and what their cost must be. It's part of the board's fiduciary responsibility every year to actually go out and obtain estimates or a reserve study and put together those estimated costs and useful life of those components and include that information in the budget. Now, one thing I do want to say, there are certain counties and cities in the state of Florida that actually do have weird requirements in regards to things like street lights, sidewalks, roadways. It's normally in the Orlando area. And I believe in some of those different municipalities that there's specific requirements that are outlined in those different city ordinances that actually get into some specific things. But from a statute perspective, there's nothing to my knowledge. Chris, I don't know if you agree with that about any requirements.
No, generally, yeah, you're right. Generally, this falls into the realm of the fiduciary duty. And again, check your documents. Your documents may have stricter requirements than what the statute has. When it comes to reserve studies, we recommend 3 to 5 years. That is important because, especially for the issues of both funding and waiving, the membership needs to know ultimately what those numbers are. And as Rain said earlier, if you had your reserve study done in 2018, the numbers that you were looking at for a lot of those projects are going to be fundamentally different than if you got a reserve study done today. Just because of what's going on in the world around us, those costs have gone up. Honestly, we're seeing at least 20% across the board. So the numbers that you were preparing back then are probably not good anymore. So if you haven't had one done the last 6 months, those numbers are not accurate. They're just not. Now they might go back to being accurate by the time you actually need that work done in a couple of years. But as of right now, it's an issue. So 3 to 5 years, get those done. The other important part is as the board, you are not expected to have the knowledge to look at a road and be able to judge personally how long it's necessary for the road to be maintained or when the next scheduled maintenance should be. Go to experts. Your manager is going to point you in the right direction. Your attorney, your accountant, everybody can point you in the right direction as to who you need to go to. Trust those advisors. That's how you get the liability protection as a board member and how you meet your fiduciary duty.
All right, I'm gonna try to hopefully address a couple of these kind of quickly so we can get through more because I'm not too sure if we're gonna make them all. Can you special assess to fund a reserve item? Yes, I do see some associations that actually reserve, or I'm sorry, that actually special assess for different types of reserve items. Maybe they didn't set enough funds aside for the roadways like they had anticipated, or maybe the costs are higher, or maybe it's something that they want to now start reserving for, but they haven't currently. So they go forth and do the special assessment for the reserve. A question that came up: if you have a pooled reserve, do you have to have a member vote to add a line item? Chris, do you want to field that one?
I would say yes. Generally, if you're going to add reserve items, you want the membership approval for that. Doesn't matter whether you're straight line or you're pooled.
All right, question came up. Recourse, if there are assets that are not included in the reserve balances at turnover. So I'm guessing that you're in a community association that was under developer control or recently turned over. This is something that gets very, very hairy and many times is one of the subjects for litigation between the post-turnover board and the developer. I can't give too much of an opinion on it. Most of the time what it is, for condos by statute, you're required to have roof, painting, paving, and any item in excess of $10,000. Sometimes there's going to be items that are less than $10,000, and it might be the opinion of the board that these items should have been reserved for. We can also have the flip side where you do have major items that are greater than $10,000 that have not been reserved for, that really do meet the requirements. I think in condo associations, a lot more is going to be argumented based on the requirements of the statute and the $10,000 threshold. In the HOA world, I really kind of think a lot of this is just open in the air because by statute, there's no requirement that you have to have reserves. It's really upon a vote or under the old statute, possibly if a developer established them, but there's no requirement of any items that really need to be included or need not to be included. Chris, do you have any types of comments related to that?
Yeah, so if you are a recently turned over association, you need to have an attorney walk you through turnover. That is an incredibly complicated process, and no board should walk through that on their own. There are statute requirements and considerations that need to be done. You also have the statute of limitations regarding how claims against the developer are run, as well as Chapter 558 for construction defect. There's a lot of considerations. Talk to your association's attorney. If you had items that you believe should have been included on there, but were not, that's an issue for your attorney to raise among the other numerous issues that I assure you they are raising with the declarant. So check with that.
All right, we've got time for about another maybe 2 or 3 questions. One here, it says, our homeowners association has an operating reserve. Is there a limit of how much can be held in that reserve account? So what I'm thinking you're meaning by that is that you're setting aside some of your operating funds and you're kind of just keeping a little type of surplus. Wondering if there's any type of limitation. There really is no type of limitation, none in the statute for condos or homeowners. Um, there's no type of requirements by the generally accepted accounting principles. You really don't have any types of IRS considerations to worry about. But if your association does have a large pile of what you may be referring to as like operating reserves, or the way that I refer to it is like an operating surplus or funds that you have in retained earnings, what you may start to run the issue is if you have a large amount of that, the membership may be wanting to know, why aren't you decreasing our assessments since we have all of this excess cash? Why aren't we paying for some of these expenses and, doing some of these other projects that we want to do? As a board member, you have to do what's in the best fiduciary interest of the association as a whole. And while it may feel good to you to have, $100,000 or however much you believe, set aside so that when you have that extra funds to meet these unknown and unexpected, you have to look at the association as a whole and what's the best interest. What I see a lot of associations do is they try to keep maybe 1 or 2 months of their monthly expenses always kind of available as cash. So that way, if they run into an unfortunate situation, major catastrophes from a hurricane or something like that, they'll have enough cash available to be able to operate to meet those day-to-day expenses without having to do some type of special assess or other types of things. Let me see what I have here. Are the reporting requirements the same if under developer control? And that is true. There is no difference. It doesn't matter whether it's developer controlled or unit owner controlled. The annual reporting requirements are the same. Let me see here. How do you move funds from a non-statutory into a statutory reserve? Chris, do you want to?
Yep, you have to have a vote of the membership to create those statutory reserves to begin with. If the membership has that vote and they create it, then at that point, in that same proceeding, that same question, you probably have a secondary question that says, assuming that we create statutory reserves in place of our non-statutory, do you vote to move the existing funds? That would probably be the most appropriate way to do that, because although the non-statutory doesn't have the rules, your documents might set in those restrictions. So again, it's kind of the Wild West. It's really difficult for me to guide you without looking at your documents, what specifically your requirements are with non-statutory. So I almost always just advise, look at your documents, but when in doubt, follow the statute. If you're following what the statute says is the normal rule, you're probably not going astray.
All right, we got one more question. I don't think we talked about this one at all. It's talking about budget notice requirements weren't discussed, but aren't they required to send a 14-day notice with a copy of the proposed budget?
So in general, you are required to send out that notice. In lieu of sending the budget itself, you can let the membership know that the budget has been prepared and essentially make it available to them in the same manner as an official records request. So at no cost to them, within 10 business days, within the distance less than 45 miles from where the association is, all that good stuff. I always just advise, send the budget to the members, send it to them 14 days in advance. Go ahead and swear an affidavit to that. It prevents a lot of problems that can result from members claiming that they didn't know going forward. And you'd be surprised how often that comes up. So that's a great question.
All right, wonderful. Well, I'm going to cut it off there because we're just a little bit past 11:15, which was really kind of our cutoff time. I thank you everyone so much for your attendance and participating. And Chris, I appreciate you being able to join us. For our attendees, if you have specific questions that you have for myself or for Chris, you can either reach out to us directly or you can reach out to us through the managers and directors edu@gmail.com. We thank you everyone so much for your attendance and we wish everyone a happy, healthy, and safe Thanksgiving, and we'll see everyone next month.
Take care, everyone. Bye-bye.